If you're furious with this market, I totally get it, but at the same time, you really shouldn't be. The market's been lacking follow-through for over 3 months at this point, and at the end of the day, it's the end of the day, and price is really the only thing that pays. Yeah, the supporting evidence looks bad, and yeah, crude oil remains elevated and CPI didn't move lower, but believe it or not, we could have a classic follow-through day to kick off a rally in the Nasdaq by the end of this week. Or on the S&P 500 side, price could just fail miserably for a classic lower high. Again, if you haven't figured it out by now, the name of the game in this market is maximum flexibility. So welcome back to the Trade Brigade Midweek Show, where we'll take a look through all of the data points and we'll build a logical trade plan. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description, and stay tuned until the end of today's show. I've got 7 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off tonight with a closer look at the SPY daily timescale, and the first thing we should try to figure out is what's going on here from a trend perspective. Of course, the trend remains in the downward direction with highs headed into this week, and the potential for a lower high here on Tuesday. But before we dive into Tuesday, I also want to talk about the lows. Lows equal lows, lower lows on really Tuesday and Friday of last week, and Monday just offers a huge lower low in the trend count. And the reason I want to talk about this first is because when we get a lower low in the trend count, we know the market can rally counter trend in search of, in this case, a lower high. So the rally from Monday is not all that like, oh my God, the trend is breaking back in the upward direction. If anything, it just yields the opportunity for a lower high, which is fantastic, right? So if we look at Tuesday's high, it is rejecting the 20 SMA, which is the orange moving average on the screen. That makes sense. We're still underneath the 50 SMA. We reject and close underneath the micro balance range lows. That's here at 680.25. And you would think if we're looking for trend continuation after setting a lower high, all you really need to do is break Tuesday's low and seek continuation in the downward direction, at least targeting these prior lows from Tuesday and Friday of last week at 669.75, if not from there, targeting the lowest low of the trend count. That's typically how trend continuation works. Well, if we look at what happened in the low of today's Wednesday session, you sweep underneath Tuesday's low, and the question becomes, do you find any follow-through? The answer is absolutely not. I mean, heck, you can't even close underneath 675. You close right on 676.25. The reason this is such a big deal, right, is because if we take a look at the hourly time scale, there's absolutely nothing in terms of structure through this rally into the late day of Monday. So you would think if you have stronger sellers, all you have to do is break Tuesday's low, which is right here. You did it once in the morning session, and you did again in the afternoon session, today, Wednesday, and neither of those times could the sellers find follow-through through the thin structure into these prior equal lows. So I'm sort of left thinking to myself, yeah, this looks like a lower high, but why were the sellers unable to really commit underneath that Tuesday low today on the Wednesday session? Now, it doesn't mean that the trend needs to immediately reverse in the upward direction and, oh my God, we need to be at the moon and, new all-time high. That's not what I'm saying. I'm just saying we don't really have the strongest display of strength from the sellers. And I mean, we already glanced over one of the largest issues of this chart, which was just that the gap down on Monday did not yield a gap fill reversal here. You did not get a classic lower high. You didn't rally into this level, offer a lower high, and then, continue in the downward direction. You actually rallied through it, right? And you did actually interfere with the micro balance range lows. Now, objectively, once again, flipping back to the daily timescale, this is still a downtrend. And I know it doesn't feel like it intraday because every single time the market gaps down, it's like, okay, here's a quick blip to the downside, and immediately we get bought back up. It doesn't feel like a downtrend, but it is. And that's what's making this market fairly difficult. And as we said in the intro, you might be furious here, but price is, it's moving lower on a daily notion, but intraday, it's certainly struggling to find traction and acceptance in that downward direction. So then what's the next major thing? Well, I would just still mostly focus on 675 from a daily perspective. It's the macro balance range. It's the major balance range overhead. If this was the micro balance range, this is the macro. You really need to start seeing price acceptance underneath 675 if the market's going to come in more aggressively. As we said in the intro, the supporting evidence does lean a little bit more so risk off. It doesn't look great, but until price actually accepts for some kind of lower high underneath 675, as we also said in the intro, it's maximum flexibility. Is it possible that this is a low and this is going to act as a higher low? It's hypothetically possible. Nothing's impossible in the market, but does the supporting evidence really say that that's higher probability? Not really. So let's go down to the hourly chart. Let's continue to build a little bit of a game plan as we head into the remainder of this week. What else should we be looking at here? If the market's going to consolidate in this range, I would sort of be between, okay, lower highs as long as we're under 680.25, and I would look to go with if we can actively get the breakdown of 675 for some sort of risk reward along these lines. And I absolutely would not overstay my welcome on the short side as we approach these prior lows, 669.75 to about 668.50. Why would I not, why would I not overstay my welcome? I think it's fairly clear that the sellers just can't really gain any traction. Look at this chart, right? The market's been in a daily downtrend through here. I really only see maybe 2-3 instances where the sellers actually did something meaningful. Number one, this breakdown here. Number two, on the break of this prior consolidation low, look above and fail. Fine. That's like maybe 3. And on today's session, maybe. It was really like we opened here, right? And then just didn't really do anything. Rally rejection of this area, a little bit soft into the lows. Maybe you could say the fourth was this instance over here, back down underneath 680. The point I'm trying to get at is that this is multiple weeks of consolidation, or technically daily downtrend in the market, but the market's been rallying, right? Far more than it's been falling through this entire situation, right? There's been more rallies in the downtrend than there has been actual follow. So please, just keep that in the forefront of your brain. If you're getting absolutely furious with the market, saying I can't believe it, this thing sucks, whatever, it's relax a little bit. Try not to get overcommitted to any particular direction. Just ebb and flow with the price action as you can intraday. I'm not saying it's easy, but that's kind of the only way to be trading this market right now. Let's take a quick glance over at the intraday anchored VWAPs. The most important one is coming from Monday's gap down, right? Notice that on the pullback today, it's at 675. Once again, I would think on a break of that VWAP, you have a bunch of disappointment from all the longs who are starting to chase this thing up through in these highs, and you just couldn't flush underneath it. So as long as that maintains itself and stays intact at 675, it's not really the worst thing in the world. Where do I change my tone on the long side? I would say if we could really grab some kind of higher low back in the super micro balance range here, over 680.25, you're probably dealing with mean reversion or at least some kind of rotation back to the top of the range. Now, is that the best long? Probably not. I mean, price has clearly been pinned down by the daily 20 SMA here for a little while now. So do I really want to be jamming longs for risk reward like this into the midpoint of the range? I don't love that idea. I got to be honest with you. It's not my favorite, but that's just kind of what it would suggest. Over 680.25, I'd be a little bit more open-minded to some sort of long setup actually starting to take us back to the top end of the balance range, right, as we just mentioned. Let's quickly hit this with some Fibonacci's before we move on into some supporting evidence. Let's start with the failed breakout to the failed breakdown dead on the lows, because the 38.2 is still right on the money at that 675 key level there, of course. Let's also come in from Monday's low, this week's low, up to this high, and notice Fib 38.2, it strikes again, it's right there. If we're above this, it's very difficult to maintain an overly bearish stance for all the reasons we've described so far today. It's the macro and major daily balance range lows. Sellers could not yield a lower high on the gap fill reversal, nothing here underneath the balance range, and 2 failed breakdowns intraday today as we're breaking underneath the Monday anchored VWAP. It's just not happening for the sellers. Let's clear that up. Let's take a look at our market internals. If you're not familiar with internals, check out the video tutorial top right hand corner. How bearish is it really? It's not at all, right? On the Monday gap down, keep in mind, this is a gap of all gaps headed into this week. Pretty substantial in terms of size. What does the cumulative tick do? Nothing overly bearish. Tuesday, really strong rally, right? Today, mildly bearish. Nothing to write home about. Volume flows this week, technically up as of the rally close on Monday. Tuesday, mildly out. Today, mildly out. Nowhere near trend lower zone, which would be underneath negative 300 million. If we take a look at the advanced decline line, here, a little bit of progress into the close on Monday. I guess the point I'm trying to make is that if we had stronger sellers, once again, on gap fill reversal, you should be nowhere near letting this thing close to the zero line into the close on Monday. And instead, we close right on it, right? Tuesday's rally sort of gives a little bit back into the afternoon. Today, really not all that bad. So at the exchange level, is there an underlying divergence where, oh my God, the market's so bearish as we're possibly, coming into this little pullback here, the exchange level is just asking for a big breakdown? The answer is no. There's no major divergence there where I would say, okay, buckle up, everybody. The writing's on the wall. It looks like it has to come on in. It's not really suggesting that, right? So we'll keep an open mind. And yeah, in the after hours, I can certainly see we're down 674, which brings us underneath that level. So for tomorrow, any opens that are below rally rejections of this area, the pressure's on, right? That's kind of what the bears would want to see. If we reclaim this, so let's say we open below, rally reclaim, just cannot maintain an overly bearish stance. 675 is the key. has to be the key. Let's jump on over to the market profile, see what we can glean from this information over here. In terms of this week, another data point, and this is the same thing as really talking about thin structure retracement on the S&P cash. If you're not familiar with market profile, by the way, check out the video tutorial top right-hand corner. Notice that here's your single prints, L period, from the Monday end of day rally. You couldn't even close them today. Nothing, right? You took out the prior day's low, could not close the singles. So not only did you not respond underneath a previous day low in a substantial way, but you could not rotate through the thin structure. Look, there's zero volume, hypothetically or figuratively. There's very little volume at price in this particular structure. The sellers should have no problem breaking through that. It's not like they have to keep chipping away at all these positions that are stacked up at the level. In terms of an additional takeaway here on the ES, something funky going on with the volume profile there. Let me see if I can refresh this without totally blowing out the chart. Here we go. Sorry about that. I just want to make sure that the volume profile is accurate for you guys, but notice that the volume profile is low in the session. All this tells me is that if people were accumulating shares today, they're positioned well at the low of day rather than at the high of day, easy to topple over the profile, right? So if we open in here, if we open in range, it's not really the end of the world. Now, it wouldn't be great, right? An open that's above value gives an opportunity for value area pullback like that, right? Something along these lines to set a higher low and continue in the upward direction. But if you're opening in the value area, at least nobody's overly panicked yet. Versus if value was higher on today's session, now all of a sudden you're thinking to yourself, ooh, we're opening down here. What does that mean for anybody who went out long into yesterday's close? They're suddenly feeling like this, right? That's not the situation that we're dealing with. If people are long from here, they're kind of feeling this way into tomorrow's open, as long as we're unchanged or possibly even a little bit higher. We shall see. TBD. And like simply put, if we do start to take out the low, then naturally these buyers will be offsides, and naturally, as we know, that would coincide with the break of 675 in the spider's cash. So, it's no problem one way or another. I think everything here just points to the idea that 675 holds the key. If you're above that, people are happy. There's no real reasons to be an aggressive bear. If you're below that, okay, the tides start to shift a little bit, the trend continues in the downward direction, we're seeking that equal low over time, right? That is what we've got here in the S&P analysis. Let's jump on over to the Nasdaq. Let's give this a reset. And in the Nasdaq, we have to just turn this entire analysis upside down, right? Which is kind of wild and crazy to say, but what's going on here from a daily trend perspective? Let's just start from the basics. This is a downtrend. Yes, highs, lower highs, equal highs on that lower high. This is a lower high and an equal high, right? And what's happening with the lows? We really didn't blow out to a major lower low. The lower wick is dancing on that low just a little bit, but for the most part, this is the New Balance range. That, hashtag sponsored, of course, New Balance. But this is the New Balance range. This is the super micro balance range, and this is the macro balance range over here. So where are we trading relative to these reference points? And then in the back of your brain, think about where the S&P is trading relative to these reference points, right? Well, you could call this an equal/lower high under the 50. We closed over the 20. We're at the upper portion of the super micro range. We're in the upper third, if you will, of the micro range. And we're in the midpoint of the macro range. So I think to myself, okay, hang on a second. We know the Nasdaq has a huge weighting in the S&P 500. And in the first little while, the Nasdaq was a larger downside pressure. And admittedly, right, this is still a lower high rejection. Let's be honest with ourselves. This is still a lower high rejection underneath the original balance range from back here. I get it, right? But relative to its most recent formation, its most recent technical structure, if you will, this is not nearly as bearish as what we have over in the S&P 500, which is a little bit of a head scratcher, right? So once again, go back to the intro. If you're furious with the market, I get it. The push and pull is annoying, but let's just keep an open mind and maximum flexibility about how this thing resolves. And I know that's not what people want to come to the video and hear, but it's kind of what you need to hear. If, let's say you're following someone online and they're like overly committed, oh, it's got to go up, we should be at the moon by now. You've been sorely disappointed. If you're listening to someone who's been saying, oh, the market's going to crash and burn, it's going to go to zero, it's going to be the worst thing in the world, you've been sorely disappointed as well. So, I want to be committal in some particular direction, but the charts are telling me to be non-committal in a particular direction. And that's just kind of the bottom line here on the QQQ. I definitely see the inverted hammers. I see the upper wicks. If you're a bear, you want to see a breakdown of the 2-day equal low. But let's just take a look at the hourly charts. The same thing, right? Unless you can actually get a breakdown underneath. And yeah, I see it in the after hours, 605.90. We're slightly below the 20 SMA. If you can get a breakdown or an open underneath, some kind of rally rejection that looks like this, yeah, you've got your thin structure retracement. But is that going to be enough to break the major balance? No. It's not even enough to break the micro balance, right? The super micro is kind of in here. You get the idea. But This rotation, I would be thinking about, is it possible buyers pick it up off that low? And you simply trade this how? Like a balance range, right? Buy near support and then sell near resistance, right? I know we're overly simplifying, the nature of markets, but that's just kind of the way to treat this balance. So as in if we start to approach this support, let's grab a crayon, please. Let's say we get in here, something that looks like that, I wouldn't be shocked if the market bounces. And I don't think you should be either. So where does it really change to being bearish? I mean, I would need to see this, then I would need to see this. You need to be underneath your daily 200 SMA at this point. I don't want to be short into the 200 SMA. That's a fool's errand, right? So underneath the 200, so I'll let this thing play catch up for confluence over here. Maybe it's early next week, and we get something that looks like that. Maybe, if you're looking for stronger downside. Now, in the intro, I also talked about a follow-through day. And if you've made it to this point in the video, please let me know by some kind of comment, whatever, down below in the comment section. But a follow-through day, as defined by IBD, is going to be on day 4 or beyond. It's usually between 4 and 7. Day 4 and beyond of a low. And ideally, we would have a plus, right? What the parameters are +1. It's more likely 1.5% in the Nasdaq, but up 1.5% on an increase in volume. Right? And so currently the configuration's there. Look at the light volume on today's session. This is day 1, which marks the low. This is day 2. This is day 3. Tomorrow's Thursday session is day 4. Right? So that could qualify as a follow-through day. What we need in the Nasdaq, if it's going to kick off a new rally, is up 1.5% or more on an increase in volume. So something that looks like this. Probably retaking the daily 50 as well. Let's just break out the measuring stick to see where ultimately, let's say we open right at the 20, and we'll of course reevaluate tomorrow morning in the pre-market prep. That's about 2%, 1.5% would bring you here, just a hair north of the daily 50 SMA. A close over the 50, something we haven't seen in about a month, right? Ever since back over here in the early stages of February, right? So that's your follow-through criteria if the market's going to actually commit or attempt to commit. Not all follow-through days work. They just give you higher odds. Some of them do fail. But no market rally, I think through the history of market rallies, and they've done this study, no market rally has started without a follow-through day, right? So that's potentially on the horizon for tomorrow's session. Hopefully that was somewhat insightful, and those are the parameters. So again, day 4, 1.5% ideally, and an increase in volume above the prior day session. Okay, that's what the bulls want to see. If you're a bear, we already covered what the bears need to see. Not only just bear flag consolidation here, but probably fail the 200 and scout out this equal low from back there. Let's quickly go down to the hourly chart and hit it with the intraday anchored VWAPs. We'll keep this thing moving along today. You could see the cluster of support right here at the 20 SMA. Once again, if it is going to break, you're probably looking at an open rally rejection, something like this, and then once again like that. Mean reversion and balance is the name of the game until proven otherwise. If we're here, that's the bear situation as we just described. If it's going to be bullish, how do you execute on this? If you rally into this zone and then can get consolidation here, I don't love being long into the 50, so it might just be wait for the follow-through day to print on the Thursday and or Friday session, right? Just keep in mind, we could go sideways for another day, pull back for a little bit, and then we could still have another attempt at it on Friday. The follow-through day setup lives on as long as this low remains secure. When I say secure, it means we do not take that low out, right? You can't wick it. You can't just wick and come back above, but as long as that's not tested, follow-through day scouting is game on. So once again, how do we participate in the upside? Let it build the follow through somewhere up here. And then I don't want to say you're free and clear, but I would definitely become a little bit more compelled if we could get a breakout through this flat top sort of pivot high here at 616.50. Something along these lines might open the door through that thin structure way off to the left. All right, so those are my thoughts around the Nasdaq. I know it might seem like, oh, geez, we get them all the time in the morning show, right? You're just saying the market can go up, the market can go down. Congrats, right? That's exactly what the markets do. It's about figuring out what price level is telling you whether or not buyers are really stepping up, sellers are really stepping up, so on and so forth. So let's not belabor the point. We could hit this with a Fibonacci really quick from the major breakdown to the lows. What do we see here? Over the 61.8 qualifies for, again, that follow through and changing the tone of the market over the equal highs. If we come in from the Monday low up to this week's high, 38.2, right on the pullback from today's session. So very difficult to be an overly bearish person or participant here. Under the 61.8 would improve the odds of some kind of action that looks like this, and lo and behold, that's perfect confluence with the 600 figure right there. Okay, that is the cues on the intraday hourly. Let's quickly hit it with the Nasdaq internals. You could see here nothing to write home about. On Monday's session, not a big blowout day, huge actual volume into the close there. You could see that here we're above the zero line today and yesterday, battling back through the zero line on the advanced decline line today. Pretty neutral close on the advanced decline line. Nothing overly bearish on the not the index score, but rather the TICQ cumulative build. Just nothing for the bears to really latch onto and say, aha, that's it, right? If we go on over to the market profile, it's a rinse and repeat of the S&P 500, but even cleaner, right? If your single prints are this box right here, I mean, you got two equal lows stacked at that point. Seller, like one of the long signals I would watch for tomorrow, look below and fail on that, rotate to the prior 2-day high. That's it, right? If the sellers cannot get it through that zone, again, tomorrow, after today's kind of weakish close, I would be very compelled to start looking for the follow-through day, start looking for the upside, starting to look for some health to be brought back into the market, right? Sellers just, I mean, like, what are we doing here? We've had every reason in the world to sell off. Market will not move in the downward direction. Now, it's not all rainbows and butterflies, because if we go on over here and take a look at the, not NASDAQ, not the S&P, but the good old small caps, let's take a peek at the balance range, breaking down. Lower high cleanly underneath. What do we know about inflation coming out this morning? Unchanged. What do we know about crude? It remains elevated. What about market expectations for a Fed rate cut in the next meeting? 0, right? About 99% probability that they're going to pause in the next meeting, which of course is Wednesday of next week. And ultimately, this is just a headwind to the S&P 500. So, you know, as we start to just maybe filter through some of the more supportive data points here, this harms the bullish narrative in the S&P 500. Right now, again, it's in a downtrend, but it hasn't felt like it. You've rallied almost every day, but the rejection is real, and you're underneath the key moving averages. I don't really see anything to jump for joy about on this IWM chart. I think you've got a pullback here, maybe for a weekly higher low, but the daily is really in trouble as long as we're underneath this 258. So if this is going to tighten up into a higher low here and then start to be constructive, that's a good first target. But really, I only changed my mind about bulls being back on parade over the 258. It's more like any consolidation in here just continues to look weak, and I would expect the downside drift, right? So that's your daily. Let's come on into the hourly chart. Notice this is just inherently weaker by spending a majority of the session underneath Tuesday's lows. So that's a clear red flag in terms of relative strength, relative weakness. And where are we in the after hours? 251.40, give or take. So 251.40 is down here. That's just a great opportunity for a weak open, look above and fail, and continues to fade off, right? So that doesn't look great here. I'm not overly thrilled about the small caps here, which is, once again, a headwind for the S&P. We could come in with the anchored VWAP stack and see where we're at relative to this. Technically over the Monday anchored VWAP, but notice that there was some time spent below, a lot of headwinds above. Even if this market does try to rally, it's just still really tough to have a bullish stance if we're underneath that 258 in the short term here. In the downward direction, if this does wash out, I'd say like Brigade bolts into Monday's low is fine. And then anything that really washes out, ouch, your next big target on the small caps are the lower bound of the weekly expected move and the daily 200 SMA value there at 239.78. That's the downside on smalls. We could hit it with the Fibonacci's to be congruent across all the data points. Doing this, you can see that we failed the 38.2. We're set to open underneath, and losing the 61.8 dramatically increases the odds of the 100% retracement, as we know. Okay, so all set there. Let's quickly hit it on a market internals side for the Russell. So it looks bearish, right? The structure itself looks bearish, but I think this proves the point that intraday, it's not really been sold hard, right? Your volume flows are fairly neutral. Build here, not really in trend lower zone there, and rinse and repeat. It's the same old story on the tick cumulative build as well for the Russell. Let's go on over to the market profile for the Rusty, and what you'll notice on this is a much deeper retracement through the single prints, but still not closing them all the way. So I would still be bearish here on the Russell general structure. Your value is shifting lower, and you don't really have as much two-day overlap. The reason I was willing to read into the idea that the S&P 500 participants down here would feel like this is because we were still mostly inside. Value was mostly overlapping with that prior day's session, and that's not the case in the Russell, right? The Russell clearly made a more substantial lower low here rather than the S&P and the Nasdaq, which really just made kind of equal lows, right? So in this sense, anybody who bought this is already feeling like this, and anybody who bought this, look at the point of control, a little bit more in the midpoint of the range, is going to feel like this if we open weak down here. So I don't love the Russell as much, and I do think that it's a small problem for the S&P 500. Let's get into the sectors where we'll start to uncover some more problems, believe it or not. So in terms of posture, it looks good on the face value. We are getting the heavyweight, it's not really a sector, but the SMH industry group, semiconductors, part of the XLK as a component, right, is leading the pack here, and that's, heavier weight risk on. Looks good. It's up 6.73% on the week, followed by the XLK itself, followed by the MAG7 ETF itself. But if you watch the Saturday update video, you probably know exactly where I'm taking this. Yeah, those numbers look impressive, but we're getting counter-trend rallies in the context of pre-existing downtrends, which we'll talk about momentarily. At the bottom of the barrel, software, utilities, staples, there was no hiding today. They sold everything into the close, or maybe not into the close, but midday off the roll from the high. Everything was sort of being sold, right? So with that, let's jump into the structural charts, and I'll just show you once again, this is a counter-trend rally in the face of what has become a backside move, right? You went out to a failed breakout, NVIDIA earnings, thank you very much, under the 20, overshot the 50. This just looks like a counter-trend rally. Look at the candle structure. Upper wicks here rejecting the 20. I would think that losing the 50 tomorrow is probably a short, even if it's just for a day, back into these lows over here, and here, right? Something that just sets a lower high. Highs, lower highs. I would love to be more constructive than that, but I just don't see a world in which I'm thrilled about trying to buy this. The inverted hammer looks ugly, right? It looks like a lower high in a downtrend or a developing downtrend, perhaps, something along those lines. Let's get on over to the XLK. You can see the same thing as the QQQ, basically. I'll give it credit. Didn't close weak down here like the S&P, kind of gave one of these on a relative basis. S&P is here, so I'll give it some credit over the 20, but it's still under the 50. We're still in the super micro range, still in a downtrend from this perspective. You could probably even just strike this trend line here. And I'm not a big fan of trend lines, but if you could pair that with a horizontal level break over 141.25, maybe there's something to jump for joy about. But I don't love this at all on the XLK. It looks more like just noise down here until we could either do this, steps in the right direction, like building out a new bull flag here. So this turns into the flag. Then over the 50 retraces this, right? That I would start to get a little bit fired up about. But for now, it's just like you haven't really done anything to change the tone. MAG7 ETF, again, a great performer in terms of weekly because of the Monday gap down. But where are we relative to the overhead supply? What a spot for a potential short. I mean, heck, this is as you'll see through the sporting or the core list of company names. I mean, this is probably an idea that's worth entertaining into the end of this week. Does the MAG7 just roll right off that 62.65? Big spot here, potential for a lower high. If we look at let's go to the XLB materials, this had a really clean trend. You're losing it. It's not as clean anymore. Could you get a weekly high or low? Sure. I would want to see something like this if it's going to be upside. So you got to retake this 50-50. Let's jump on over to the XLY. This doesn't look great, right? This is a heavier weight risk on sector. Look at your trend line, rejecting the 200, rejecting the 20, closing weak. I just can't get jazzed up about these heavyweight risk on sectors. XLI, I mean, it's maybe medium weight. It's maybe got a weekly higher low. It looks better than the XLB with the potential for a higher low over the daily 50 at least. But how does this materialize as a double bottom? You got to be over 172.80. Go look at something like a Caterpillar, right? And you'll say, to me, it looks like a counter trend rally in the context of a backside move. Doesn't really look constructive yet. You'd either need to base out here for a little while longer and then set something up for higher, or you just drift away and like Caterpillar becomes a figment of our imagination from long things lost, right? Let's go on over to the XLV and see what we've got in healthcare. This doesn't look great, if I'm being honest. You really would have liked to hold the bottom end of the range. I'll give it some credit into the end of the week if we go look below and fail and we find ourselves in here. I'll give that some credit, TBD, on the XLV. Let's go to the XLC. Not much to really comment on this, just still very neutral inside the moving average tanglements. Couldn't really move out higher over these equal highs from here, so hard pressed to say anything overly constructive. I'll keep an open mind because at least it's neutral. Let's jump into energy. Looks just like a bull flag to me. I mean, simple break of this trend line is possibly interesting with the way that crude remains strong. Possibility for some more upward pressure there. Something like your XOM honestly doesn't look half bad, retaking the daily 20 SMA. Let's go from energy over to IGV. And what do we see over here? Still sort of in the camp of flag over the 20. I understand it's absolutely still an aggressive weekly downtrend, but in the meantime, it's not really doing anything so horrific, right? This has been a very orderly pullback in the IGV since this rally started versus some of the more violent pullbacks we talked about in the Saturday video. This is pretty controlled. Pretty darn controlled through here. So watching that closely, I would like to see if it could stage a daily higher low attempt over the 20, then curl into the 50. That would be the next sort of look there. And that would be bullish pressure for the market, but it's just one component out of everything we've looked at so far that's like, maybe it's good, but it's not great, right? Why is it not great? Because of, again, the overall, overwhelming, I should just say, downtrend on the weekly. Utilities, I think still possibility here for cup and handle, up and over. Not the greatest close today, but still within the confines of that handle zone. Going sideways to digest this huge move in the upward direction, we'll give that some credit. Where I would start to be a little bit more intrigued by the behavior here is if this really starts to wash out hard and move lower, that would kind of be a risk-on signal, right? Risk on if utilities start underperforming and the performance maintains itself over in the heavyweight risk on side. So I'll be keeping a close eye on that in utilities. XLP is another one, right, where this had a straight up move and now is coming in fairly aggressively. This is not as orderly of a pullback as like what you'd like to see. This generally could have been a little bit more tame. You set a daily, weekly high or low and then you push out, right? This is a little bit more aggressive than that. So 50 SMA is usually a good spot for a first bounce. If this can just go like gap fill reversal and remain weak, that would be pretty telling, right, on the XLP, because once again, this is a risk-off sector, and it really told us, like, hey, watch out in the market, and now it's starting to say, okay, we're not really doing that great. So you could kind of, put the pieces of the puzzle together when I was saying there's no hiding. None of these charts look overly enthusiastic for upside. If you look at the XLF, this thing's horrible. This is the second heaviest weight sector by market cap. Financials and banks are just abysmal here. And what's that telling us about the state of affairs? Probably just walk back a little bit of that optimism about, hey, utilities are maybe going to break down and staples are going to break down and maybe it's risk on. Well, XLF, you probably don't want to get all fired up about this with just kind of a hammer, equal lows. You could counter trend bounce and that's fine. You could close this gap. You could come in here. You could reject 5120. You could bounce, but it's not going to do anything to change the trend yet, right? XLRE, this is what I was saying in the intro when, the supporting evidence looks bad, but price is not paying shorts in the S&P unless you're holding stuff overnight, right, or over the weekend. Real estate coming back down into the range as rates really ramp in the upward direction. Let's kind of speed it up through the back half of supporting evidence. Sector ratio grid. If you're not familiar with ratios, check out the video tutorial top right-hand corner. I'll give a little bit of credit to the XLK. It's still underneath the 50. So in my view, this is just a great spot for a potential rejection, if I'm being honest. And if this rolls for a lower high, problematic. If it can retake, I'd be a little bit more impressed. But that's about the only bright spot. XLC still looks good because of how sideways it is. That's really it. I don't see this as a big flip to risk on in the dashboard. If we go on over to the ASET, what we've been talking about in the group is just like, things aren't really getting worse. We've put in some sort of like local lows, but is there any major improvement? Not really. We have declining 50, declining 50, declining 50, declining 50, declining 50. The only thing that looks good, semiconductors versus healthcare, right? So I don't know, once again, that this is a full bore risk on environment. I would love it to be, and I'd love the market to finally pick a direction and a trend. We just don't have it yet. If we go to the B set, what do we have over here? No change to the gold ratio. Sailor shift tool starting to fire green on Bitcoin here. We'll see if that can perk up and close that way into the end of the week. And if we get a strong weekly bar, perhaps early longs next week over its high could get interesting. One thing I do want to point out is a subtle shift here on the SPY TLT ratio. We did close strong on that today. We want this moving in the upward direction for increased risk appetite. It's a subtle shift. We're still underneath the daily 50 though. It's hard for me to get fully fired up about it. Let's keep moving along and take a look at the dollar and rates. As we can see, the dollar is, looks like crude is making a move above 90.82. That's not good. I wonder what the news headline was on that. Dollar inside this balance range on CPI firming up today. Firming up today. Apologies. Makes sense, right? With rates sort of forecast to be unchanged, if not higher, to protect against inflation. Look at what the 10-year is doing. That's not really great. And we'll also add in here the bond duration before we jump to the Fed watch tool, just to show you the technical bit first. These lines moving in the upward direction tell us that the market is a little bit more concerned about inflation versus moving lower. It's like, okay, maybe the market's not as worried. But now with the whole crude oil debacle, bond traders are pricing it in. They're pricing in more problems for inflation, which is going to spell a headache for the Fed because we know the labor market report came in absolutely abysmal last week, 92K negative on the Friday jobs report. And this morning, if we just jump over here, let's just go take a look at, let's go here to the economic calendar. This is not really what the market wanted, right? Sure, it was the consensus view. It's what the market was pricing in, but the market wanted to see a beat here. We wanted to see a big beat with on the inflation rate year over year, something like 2.2 would have been well received by the market. Wow, we're off to the races. On the inflation core year over year, something like a 2.3. something along those lines, wow, the market would have been impressed and just, off we go. The Trueflation gauge is supposedly saying about 1% inflation. Again, it's probably somewhere in the middle. It's probably not exactly 1.08%, but it's probably also not 2% or 2.4%, excuse me. So, it's hard to get a firm grasp on what exactly is going on there. One of the things in the components that did come in quite well, I don't think I have this pulled up, but we could very quickly find it. We just hit the folder and come on over here. We just want to look at shelter. Shelter inflation didn't really, come in all that bad. A 0.2 is really what you want to see. You want to avoid these. The 0.4s are the scary part for shelter inflation. So seeing that back at a 0.2, that's pretty stable. Shelter's an anchor for inflation, right? So that's not a bad look on that. I thought that was probably the biggest positive note of the inflation report. As we go back out to the Fed Watch tool here, you can see even post CPI, we're still dealing with about 99.3% odds of a pause in the next meeting, and the next cut is being pushed out all the way to the September timeframe. This is another thing that we've been talking about on the channel. Forget about June. It's now about September versus July, right? And the market with stable inflation is not going to price in sooner rather than later. They're going to say, no, we're going to hold out longer than expected, right? Let's jump on over into the calendar again, just to figure out what the rest of the week looks like. We have jobless claims coming out on Thursday, the usual stuff. Pay attention to natural gas storage, the same reason we pay attention to crude oil inventories today. And 30-year bond, maybe. I'd say more importantly, the Friday session. You've just got a smattering of delayed data here that's going to be released. Probably important. Most important is going to be the intraday response to the preliminary number from the University of Michigan folks, consumer sentiment and inflation expectations. That's the big watch. A little less interested in jolts, considering the market already got the negative 92K from last week. Let's go from here on to the earnings calendar. Oracle earnings looked good at face value. The stock gapped up big time, although it was a great fade right off the daily 50 SMA. So Oracle gap and go, or maybe, gap, attempt to go and then fail. It was probably more of a short than anything else. I know a lot of traders are looking for that short off the 50. Glad to have played a little part in that. And then on Thursday after the close, it's really here. That's the next major set of earnings for the market. Adobe, Rubrik, Sentinel, that's really it. Okay, so pretty quiet on the earnings front. We know it's going to be that way for the next little bit until we enter the next cycle, which will be kicked off by bank earnings, which is a ways away, all the way out until mid-April. So we got about a month to go on that. Let's jump into the charts once again, and let's take a look at credit spreads. We'll continue through our supporting evidence. This is not what you want to see. So if you're a bull, seeing these things expand, not good. That's a sign of risk appetite decreasing. Let's jump on over to the HYG in isolation. We did this exercise with the group. I'll do it with you guys here as well, just because it's kind of important that you get it right. You have to make sure that these two things are zoomed to the same exact time scale. You cannot be on two different time scales because the slope of the line matters, right? Notice that this higher low is much less steep than the higher low in the SPX. And if you really want to split hairs with me, you have a low here and you have a lower low here into the close on today's session versus the S&P. You have a low, you technically have a higher low. Right? So is there a subtle bearish divergence happening? Yes. If you want to be scientific about it, you could say, okay, the slope here is about 14.68%, or percent, degrees, my God. It's been a while since geometry, huh? And then over here, the slope is about 32.55%. So you're dealing with more than twice the steepness of the slope there for the higher low. It's not the biggest bearish divergence. I mean, usually you want to pay attention to the most obvious things, which would just be like, if you got a higher low here and you got a lower low over here for this, that would be very obvious, right? But it's subtle and it's maybe worth paying attention to. It's a little feather in the cap for the bears, of course. Let's keep moving here from HYG into our total breadth. This is another reason why the market does not really scream like, hey, this is awesome opportunity, long buy. Your breadth has been deteriorating quietly in the background. Look at your RSP. It was one of the reasons why the entire market through the early stages of the year, we were like, okay, maybe we're holding up all right and things are okay and the broadening out of the market rally, small caps are performing well. As soon as that narrative went out the window, your RSP deteriorated in a meaningful way. You kind of strike your trend line here. Your percentage of companies over the 200 SMA and then the 50 SMA rapidly decelerating. Your new highs versus lows, there it is on the screen now. You could see that that's still under the zero mark. That's not really what you want from a breadth perspective. Now, let's just quickly go full screen here because I do want to show the April lows. This is like quiet deterioration that will eat up the charts in the background and produce a more bearish outcome. The, oh no, it's just oversold and it should rebound, that's when you get down here. You're talking about components, less than 20% of the components above the 50 and above the 200 in the S&P 500. we're not like, I guess what the point I'm trying to illustrate is that we're not close to oversold territory yet. This is not an oversold market. If you think that this is oversold in the S&P 500, then I've got a bridge to sell you over an ocean in Kansas, and it's just like, come on, this is not oversold by any stretch of the imagination. This could get a lot worse, right? So that's your breadth. It does not look great there. QQQE, while we're on the topic of breadth, just in the midpoint of the balance range, not really doing anything impressive. Let's finish it up with volatility. VIX remaining elevated here, not really breaking down aggressively. VVIX on the bottom, still staying over 120. That is bearish, as we know. That's the warning signs are going off. Oops, there's the VVIX anyways. Just trying to be efficient, but that was apparently not the right call. Let's go on over to the volatility futures. Still in a pretty deep backwardation here. The long signal, as we know on this, is when we close up and over the zero mark, and the S&P 500 has the potential for a follow-through day. If that's the combo, then awesome, fantastic. We're looking for longs, but as of right now, still in backwardation, telling us that the market is very uncertain. We just got that alert literally live here as we were recording the midweek market update. Look at crude headed north over the hammer high, over the 90 handle. That is not really what you want to see. And for the sake of being somewhat transparent, if you're in the group, you obviously had updates through the entire trade. When I put it on the whole 9 yards, I had to close out my crude short today. So it was great to sort of literally nail the high on crude Sunday night and then have it come in. SCO didn't literally pay off as beautifully as just being short CL futures were, but nonetheless, a great, fantastic move. And the runners had to get taken off, right? There's no reason to hold the runners if this is going to remain elevated and stop working. So crude is off if you caught us talking about that in the live stream and whatnot. Just to be, clear, no more crude short as this thing starts blowing back higher. Anyways, we were on volatility. We were talking about contango and backwardation, and crude is just another indication of volatility and hence the Middle East situation. So pay close attention. And then over here on the VIX one day, we have this trend line there. When and if that breaks, maybe we have a normalization, but the biggest thing I'm watching for is your vol futures back into contango. Let's just maybe check in on skew and the put call ratio just to get a little sense. Yeah, nothing crazy on skew, no new high. I'm a little surprised by that. I'd figure people would be reaching deep into S&P 500 for that, but not the case. And then P call over here. How are we doing on put call? Let's go to a daily chart. Yeah, really not overextended in terms of the number of puts in the system. That's, depending on who you talk to, that's, quote, a good thing, right? It means, nobody's hedged and, the market can crash and burn. I know I'm drawing a down arrow on the ratio, but you get the idea for the S&P 500, right? Nonetheless, what's the bottom line there? I don't think there's anything special to parse out of skew. I think that volatility is still elevated until the Middle East situation really calms down a little bit more. I wouldn't expect much of a change for that. One thing I will be paying attention to is if the vol futures tell me that the situation is calming down before the news headlines do, I will go with the futures, right? Price always knows before the actual headlines start to get written, right? So just be aware of that. Don't follow news. Don't follow the headlines. They can help you sort of shape a narrative, but please let price lead the way. All right, we've spent enough time on this. Let's get into the core list of companies. Let's finish up on a strong note with those 7 trade ideas, and we'll be on your way for Wednesday night. NVIDIA still just looks like a lower high potential here up against the moving average stack. I know some folks probably trying to get involved here short side. We did certainly do that on the Tuesday session. So today, didn't really continue lower, but underneath these lows, I think that's the trade, right? So 184.25 is the next key level to break. Let's go on over to Apple. Lightest volume in a long time on Apple. So please just understand there's not a lot of interest in trade. I mean, look at this. This is hardly anything. This is 59% of the average 20-day volume. Horrendous in terms of participation in Apple. Still seeking a potential lower high in here and maybe some downside than this. Turns into a descending triangle. I could see it. The last time we had light volume like this was over here. This was just a bear flag. Is this just a bear flag? Maybe. Not my favorite chart to watch, so let's keep going. Microsoft, it's not really doing anything wrong, but it's not doing anything great. I think like the IGV, trying to watch for a higher low setup over the 20 SMA, and then maybe something that looks like this. Maybe there's a trade over 412. It needs to set up a little bit more. I don't think this looks beautiful. In a picture-perfect world this morning, you would have just accepted here, and then tomorrow would have looked like that. So TBD, but not really wanting to get short into the 20 either. I would kind of let this thing be for now. Let's go on over to Amazon. This one's very similar to Microsoft in the sense that you have the same sort of bottoming formation post-earnings, but this is still over the neckline. If we could stay over 212 on pullbacks or some sort of Brigade Bolt recaptures in here, I'd entertain Amazon longs off of that 212 level. Let's jump on over to Google. one of the weaker names out there, I think, still. You may be saying, like, weaker, what are you talking about? I just think it might need a fall from grace. Maybe not need, but it could still fall from grace. Let me frame it that way. So if this is going to be your lower high at the moving average, the 20 SMA, then I think that very straightforward is just hourly, head and shoulders or something of the sort. Underneath 305.50, you could manage risk easily against that high if you're a day trader, right? Something like that. Intraday is a little bit more attractive, looking for the 510, 510, the 5 or 2 minute Brigade bolt underneath the 305.50 for your entry point, right? It's going over to Broadcom. Not much to really write home about on this other than the potential for a hold there. So I don't love the action over the last 2 days. I think maybe tightening up against this is fine. I would honestly like to see a look below and fail on the 50. Give those shorts one more glimmer of hope. I know, a ton of people short off the 50 in here. I'd love to see them try to get involved in it again under the 50, only to have it snap back hard and do something that looks like that. Now, I'm not wishing for anyone in particular to lose or anything like that. I'm just saying, if we could sucker in the shorts one more time, boom, something that looks like that, I'd be interested for a higher low. This has been a very stubborn short ever since, really pre-earnings over here, really over here as well. This inverted hammer or inverted head and shoulders, kicked it off. So I would sort of like, I would like this. That would sort of make sense to me. Look below and fail on the 50 as a possible long side entry for a higher low over the top end of these highs. Spoke about that enough. Let's see what's going on with the metaverse. This is one of my least favorite charts in the market right now. Just really, really not much to say about the 20 and 50 2-day balance range, multi-day range here. Pass. If we're up here, maybe it starts to do something interesting. Don't like it in there. If it's this, maybe gap fill reversal, TBD. Tesla, another one that doesn't really scratch my fancy or scratch the itch. Nice. I know a lot of people made money on the bull flag breakout today, and congrats, awesome over the 20. I don't like the close. I don't like the upper wick. It's still not in a daily uptrend. If anything, it just rejected the moving average and or the trend line again here. So I don't see it as being constructive, if I'm being honest. Like, just let this thing be in here. I still think the short trade is possibly on. That's a bad illustration. Let's try this. Something in here underneath 386.50 is much more compelling for a bear flag, and then you have your thin structure, low volume void off to the left, right? If I just zoom out, this is where that's coming from. There's literally, hardly any volume there. So this is the idea if it's going to be a short. It's going over to JP Morgan. We talking about how bad financials are. I mean, look at JPM. Same thing. 292.50, big headwind staying underneath. You could say hammer all you want, but structurally and price level wise, 50 barreling down on the 20, which is underneath, of course, 20 crossing the 200. There's like all the classic price structures here are not doing well, right? This is all overhead supply. It looks bearish to me. It's going over to Palantir. A little resilient today, scratching underneath 150, but I don't think out of the woods. The idea for me on Palantir is let this thing head and shoulders underneath the neckline and then reevaluate here. Do we have some sort of higher low pickup at 145? And can we build out, is this going to be some sort of like, dirty cup and handle like that on the low? Maybe. We shall see. But for now, in the short term, definitely under 150 gets interesting, back towards that 145. Let's get into AMD. Another one that's just kind of like stubbornly not ready to give it up yet, but still looks like it's weak. I'd like to see it fail the 20. Something in here, just like NVIDIA, same concept, different name, right? So both of these ideas are still in play. Call it a head and shoulders if you'd like, and then we're here, right? That's the name of the game there. If you're just consolidating over the 20 and sideways like this, a little less interested. Not really in love with AMD through this thin structure. If it was going to go today, it should have rallied and then closed strong up at 212 through this thin structure, and it didn't. Right, so I would think this is the next big deal. It's going over to Robinhood. Until Bitcoin strengthens up, I think you're going to be stuck here. This is a mirror image of Bitcoin at this point. So over 80 could get interesting if Bitcoin is strong overnight. That's about it. If you're just in here, not interested on Robinhood. All right, let's get into these additional ideas. First is on ARM. Ticker ARM, semiconductor designer, just like NVIDIA, but not nearly on the same level. Lower high here underneath this overhead supply after a failed bull flag over the top. So I would think inverted hammer. I don't know about being short into the 50, but the idea here is to possibly look above and fail on the 20 and shorts. I think the better even NVIDIA and AMD look better as chart setups. But this you could just add, throw it in. What do they say? Throw your name in the hat there. ARM. You could also play a role here, and it's also just inherently much weaker. Look at this horrible price action over here, and just never really caught a bid like any of the other big designers did. So that's ARM. Let's go on over to MP, which is not precious metals, but key minerals, critical minerals, and resources there. So rare earths, that's the term I'm looking for. Goodness, brain fart. Inside day today, possibly up and over this high, could get interesting. I've had this alert since way back over here and even over here, so we'll see. Is this inverted head and shoulders off the 200? Possibly. This could be the name of the game there, over 63.75. So we'll watch MP. You could add CRML into the mix as well. Not as good. You could maybe argue for double bottom over the 200. Inside day today, I think the MP looks better. So that's CRML also in that list. You could say UAMY, USAR. Those also fit the group, but I think those two charts are the best. AFRM, this is a maybe. This is a counter trend idea. So let me just, before we go any further, this is a counter trend long in the context of a downtrend. Let's get that out of the way first. Inverted head and shoulders, sure. This kind of flag here, the reason I like it is just this thin structure right there. So over 52 to 57, possibly for something along those lines. That's if the market rallies, right? I would not try to take this trade if the broad market's failing. That's a firm. Let's go to OKLO. This is actually something I'm really interested in having on the watch list tomorrow morning to be very aware of. Underneath these lows, I think you have equal lows. And the way to do this is you could use puts if you'd like. The options change a little less compelling. OKLS is the ticker to use on that. And Brigade Bolt underneath the 2-day low, equal low there, target. And that's like a 16% move on the 2x short, right? So that's about, let's just call it 8%. So 16% on the 2x short. We'll see. That's kind of the idea. OKLO short. Let's keep moving into BTU. Trump was just speaking, and he was speaking about coal, if I'm not mistaken, and BTU right in there. So I think this is more of a higher time frame, maybe weekly bull flag and/or cup and handle. So we'll see. We're seeing it start to reclaim not the 200, but rather the 50 and the 20. So does it start to set something up? Maybe. I don't know exactly what the entry tactic is here yet. Probably worth reevaluating over the next little bit, but I just think it belongs on a watch list. Could it be as simple as that? Maybe. TBD. So watching this BTU over the next little bit. KR, Kroger, grocery stores. Probably have to do this with shares. I don't think there's a levered ETF on it. Options are abysmal. Classic Brigade Bolt, something along these lines, 71.85 into 74.80. May or may not be worth your time. Depends on your style. Depends on your risk appetite. That's a pretty slow move, right? That's $3.5%. I don't know. May or may not be worth your time, but KR right around in there. Let's jump from Kroger to the final one, which is BMNR. And this, of course, is your Ethereum Tom Lee. And just a very clear pivot there, up and over 21.75. If we start to catch any strength over in the crypto markets, remember, Bitcoin is technically triggering a bullish Sailor Shift tool. You've got thin structure retracement off to the left. Over 21.75, 50 SMA first target, and then really these prior lows from over here, which are, if we grab the right drawing tool, I'll let you know. And then if you really want to throw fuel on the fire, so that's 27 there. And, this is a crazy move, right? Let's just see. That's like a 25% move on BMNR. If you want to throw fuel on the fire, you go BMNU. BMNU would give you about a 89% move, okay? So please play that extremely carefully because just as fast as you could get 89% here, Ethereum tanks, and this is levered, so you're going to suffer decay, you could find yourself down 25%, right? So is 25% risk worth something for 90% upside? I would think so, right? You're dealing with 3-to-1 plus on that. So the risk reward skew, if price actually makes it here, is fantastic, but just understand that you're playing with fire here on not BMNU. I don't know if we ever needed 2x long BMNR. Anyways, that's what I've got for you in today's episode and installation of the Midweek Market Update. If you enjoyed the video or learned anything new, let me know down below in the comments section or by giving the video a very simple thumbs up. As always, we'll be live in the morning session for 8 o'clock Eastern time. The pre-market prep, we'll do another episode and installation as we typically do every morning live here on the channel. We hope to see you there. With that said, have yourself a green and fantastic rest of the trading week. And as always, I will see you in the next one.